Ladies and gentlemen, prepare yourself for the next recession. That's what we're going to talk about in today's stock market brief. As you saw, we have a lot of slides to cover, and we're going to be hopping right into it. Now, as I stated, we're going to be preparing for what is taking place. So we're going to be going over important data that you should be made aware of. And really, it comes down to doing a lot of the opposite of what we are seeing on the screen. Then we're going to obviously get into some of the stock market charts too as well. We had important data come out. I'm not going to waste your time. We're going to get into it. These are known as the four walls. Now, if you follow Dave Ramsey, he talks about these. Now, this is very important to understand because as a consumer preparing for a recession, you need to make sure your four walls are in order. These four walls include food, utilities, housing, transportation. Now, it's important to understand what's going on within these sectors too, which we'll talk about because we got the CPI report. Before we do, let's talk a little bit more about the consumer and how they're doing. Maybe it's you, maybe it's not you. But if it is you, well, we got to start doing the opposite. Now, Americans currently lean more on credit cards as expenses stay high. 46% of cardholders now carry debt month to month. That's a large increase that was reported by Bankrate. If we continue on, take a look here at revolving debt or credit card and other revolving debt. We're up 16.3% year over year, which is a large increase. So we've been up here for quite some time. So a lot of credit cards are not being paid off on a month-to-month basis. And on top of that, credit cards are actually increasing. All right. But not only that, take a look at the interest rate on credit cards dating all the way back to 1996 over here. You can see, boom, we came up at 19.07 as far as the interest rate goes. Okay. So this is a large increase in interest rates. So consumers have more credit card debt, it's being held, and on top of that, interest rates are going up. As we already know, the Fed has been lifting rates here. Typically, this fuels bubbles, and this right here deflates bubbles. Now, personal savings rate is near an all-time low, right? 2.4. This is telling me that, hey, savings are low, but yet they're racking up their credit cards. Take a look at quarterly change in deposits. This is a chart that I also shared. Once again, boom, in the negative. So customers are putting less money in the bank, spending more on the credit cards that are expensive to carry balances over. Look at the delinquency rate as far as by loan type, 30-day delinquencies. Auto loans starting to increase. Remember that. Credit cards starting to increase there too as well. Take a look at 90-day delinquencies by loan type. So these are on the increase there, right? As well as auto loans too. Even mortgage, you can start to see an uptick there. Talking about mortgages, the quarterly transition rates for current mortgage accounts. 30 to 60 days late, take a look here. Now this is going from Q1 21, you can see starting to uptick right over here, okay? If we just go over here at mortgage originations by age, look at the large amount of mortgages that were created in around that same time. So during the time where the Fed fueled, right, slammed rates down in 2020, and everyone really started buying homes, well, guess what? I mean, you could see that right here. Boom. And now all of a sudden, delinquency rates are starting to go up. Interesting. Okay, let's continue on. Take a look at retail sales. This is important because it lets you know, hey, is the consumer spending money in retail stores? Well, we just saw a big move down the other day on the report, week over week, right? 5.3%. From the previous week, it was 10.2%. So we're starting to sink down there too as well. Even small businesses, confidence is falling off a cliff. Take a look at the unemployment rate. This is going to be very critical to pay attention to. The unemployment rate is at 3.5%, right? That was where it was right there prior to the pandemic spike. And we're pretty much at a 50-year low, I think it was reported. Okay? Now, how can all these problems amplify? See, people are hanging on right now and they have jobs. Some are working multiple jobs. So what happens if the unemployment rate spikes and you have delinquency rates already on the rise, credit cards, balances, and new accounts are being built up? We'll take a look here. The companies conducting layoffs in 2023. Here's a partial list. Now, we already know that there was a lot of layoffs in 2022. Coinbase, Bed Bath & Beyond, BlackRock, Goldman Sachs, Amazon, Salesforce, Stitch Fix. That's just to name a few. All right, now let's talk about inflation. President Biden posted this for the 6th month in a row. Woohoo! 6th month in a row, yearly inflation is down. Now, it's true. Core inflation is down 5.7%. Still relatively high. It came in at consensus, and we know how the market reacted. It was a chop fest. We'll talk about it. But take a look here. We'll look at specifically the report. This is looking into it. Now, core inflation, 5.7. You can see that number right over here, 5.7. All items, less food and energy. Okay, so that's what that is. We'll talk about the food and energy portion after. Remember what we talked about. Food, utilities, housing, and transportation. We're going to talk here about housing and transportation. Now, if we go back to the report, there is housing and transportation. Now, take a look here. Ooh, okay. Used cars and trucks are down. So that's what's really bringing this report down. Yeah, okay, cool. Used cars and trucks. The price is coming down. But as we already know, auto loan delinquencies are on the rise. And take a look here at 90-day delinquencies. Ages 18 to 29, 30 to 39, a huge spike up already. So you're telling me that people already have cars. Okay, so if they already have cars, then they're not, does this really affect them? No. Go back to the four walls. What do we say that does? Transportation. Okay, and then we'll get into housing. Let's go back over to the report. Transportation, 14.6. Oh, okay, that's a high number. So something that's incredibly important is actually going up in price. What about shelter? Oh, up 7.5. Oh, rent and primary residence up 8.3. So two of the walls that are incredibly important to consumers are up. Ooh, congratulations that used cars and trucks that people already own, for the most part, is coming down a little bit. Now take a look at the people that do own those, motor vehicle and maintenance. Whoa, up 13. Okay, so far the four walls is not looking good, okay, for consumers. Okay, housing and transportations, but let's get into food and utilities. Okay, moving on. That means we have to look at the United States inflation rate year over year. Consensus was 6.5%. The actual rate came in at 6.5%. The market doesn't know how to even interpret this report, as we saw with all that chop. So let's look at the report here. As you can see, we came in at 6.5%. That's all items. But let's take a look here at food. Cereal and bakery products, 16.1%. Dairy and related products, 15.3%. I'm sure you heard about the eggies, right? Well, meats, poultry, fish, and eggs, 7.7%. And then that is for the food category of the wall. So you're telling me consumers have to pay more for housing, right? Their rent, their housing, right? Transportation is increased. Food has increased. And now we're looking at energy, and energy here is at 15.6. So take a look here, electricity and then utilities, all right? 19.3 for utility, 14.3 for electricity. So let's go back to the four walls that are incredibly important to make sure you have your house in order. As a consumer, okay, to recap, we have not a really good savings rate. We're putting less in the bank, but we have a lot of jobs, but unfortunately everything is getting expensive across the board. So we're racking up our credit cards, we're opening up new credit cards, and now we're starting to have to pay interest on these credit cards at a higher rate. Tell me where this is actually good news. It's not. It's not good news, and we have a long way to go. So the Fed is going to continue its path of holding rates high, and we'll see here if they pivot, if something breaks. It's always a possibility, but as it stands right now, people, the consumer is getting squeezed. Now, we talked about how we prepare for, right? How do we prepare ourselves for the recession? Well, we need to make sure this, as individuals, we can take a look at this economy as a whole and get wiped, like all flooded with rage and emotion and all kinds of stuff. But you need to get your economic house in order. And in order to do that, you need to make sure you're not the one racking up credit cards. You're not holding a balance over the time, right? And you got to figure out a way to reduce your credit card balances so you don't need to continue to pay. And you need to find a way to increase income, because that is really the only way to survive this really next recession that's bound to happen. And unfortunately, it's the lower income individuals that get hurt the most. Yeah, there's going to be a wealth effect to people that make more money. But understand this, in order to take care of yourself here, it's all about increasing your income, decreasing your expenses, and making sure that you have savings for food, utilities, housing, and transportation, because those prices are going up, okay? So that's how you prepare. Hopefully that data really kind of helps see what's actually taking place and structured correctly. Now, we know that the market ran up today, chopped around. Now, we have earnings season now coming on. So as the banks come into play. Then we're going to have, retail with tech. We'll have all these people reporting earnings. And understand that if the consumer's getting pinched, all right, that's not going to be great for businesses over the course of time, which could lead into, obviously, an earnings recession. So we have all the likes of BlackRock, Wells Fargo, Citigroup, JPM, UNH, BAC. We got a bunch of earnings. If you want to screenshot this, these are the expected moves going into the earnings report. So we got some obviously the vols all swollen up like a balloon over here. We'll see how they report, because it doesn't mean that the market's not going to go up, people. The market can still go up despite all of this stuff, but understand that there is still this looming in the background. It's not going anywhere. And you can see here, banks don't typically like inverted yield curves. The 10-year and 3-month is now 123 basis points inverted. Okay? The 10-year and 2-year is minus 69 basis points. And as we've seen prior, if you take a look here at the 2-year, 10-year, and then below that is the SPY. Okay, as soon as it got into inversion, when we get these bear market rallies, so for example, right here, boom, but the yield curve was continuing to divert, and then all of a sudden, hey, what do you know? There's this little divergence here, and then all of a sudden, boom, price started to get hit to the downside. Excuse me. S&P 500 was rallying while the yield curve was coming down further, started to fall. And we're seeing the same thing here. It's starting to fall, price is going up. So we'll see here if there's a turn, right? If the yield curve wants to start coming back up a little bit, perhaps the market takes a little bit of a back seat. Now, if we take a look at the BP charts, like the financial sector, because they are reporting earnings, not too far off from being overextended over here to the upside, still has a little bit of room to go. BPNYA just finally made it into that overbought condition. Doesn't mean that it can't go higher and create a negative divergence, like we've seen something like that play out where we called that top right there and we called this little positive divergence right there, and now we're starting to see a pretty solid rally overall. If you take a look at the S&P 500, we came into an important area of confluence. The 200-day moving average, we filled the gap, and we're at that upper trend line. So are we going to get some sort of bull trap, or are we going to get bad earnings, right? In order for the S&P 500 to run, we need financials to move too. If the financials don't start moving, right, we got some big market cap names there, it's gonna hold the S&P 500 from really thriving. We'd have to really rely on tech, and we know that tech's been getting hit hard, and now we're starting to bounce from oversold conditions there. Now, this little, consolidation and this run up, we saw coming. We saw it in the parabolic SAR over here on the NASDAQ McClellan Summation Index. It clicked over, gave us some insight that the trend could potentially change. It's still pointing up, so it's still positive. The trend is positive. Doesn't mean that it can't come down, this can't come down, and then still move up, and the market continues to, go off right into the sunset to the moon. Always a possibility. We will trade price. Take a look at NAMO. NAMO, NASDAQ McClellan Oscillator, amazing breath today. Big old push, but it is getting quite overextended to the upside. So, like I said on the prior video, to see some sort of consolidation, pullback, etc., is likely here in the very near future. If you take a look at the SPY, we tagged that weekly upper expected move, got a little bit of up to the upside of it, and then we started sinking right back within it. We're still above an inclining 5-day moving average, and that, to me, still looks bullish, people. At this particular point in time, until proven, otherwise. We talked about when it was declining here, we said a bunch of times, go watch the videos, we want to see it flatten out, and then we want to start to see it curl up, and we want to see the market do something like this. And, well, it bursted out, and it came back down, and started moving back up. Now we do have a negative divergence on the RSI, negative divergence on the price momentum oscillator, still at this particular point in time. Keep an eye on that 5-day moving average. Sometimes when it gets too increased, it could take a little bit longer of a period of consolidation. The VIX got completely crushed today, down 10.72%. Now, I will call out that is coming into an area where we found some prior areas of support and where bear market rallies really started to kick into play. You can see here in April, it came down to this range, and then as soon as it started spiking up, we came down. Came down here in August. Boom. What happened? Started moving up. We started going down. Came down here in December, right? Boom. We started moving down. Now we're back here again at a low that we haven't seen really since April. So, hey, is it going to hold down there? Is it getting a little too overextended? As it stands right now, the market has been on a rapid run. We're seeing a lot of short basket, cruddy little names start to fly to the moon, right? Bed Bath & Beyond being one of them. And this typically is what happens during bear market rallies. Now, if you take a look at the zones, it's lighting up bright red. So this is time to be cautious. This is time to be careful. It's a time to update your risk parameters. If you have long positions on part of the Discord community, that is one thing that I've been saying. I want to wait for the CPI report to pass. But right before that, I was just looking at all the long setup. I just said, yep, start to update all these, start to update all the stops, because if we start to get hit, bam, it could be hit, and it could get hit fast, hard. We don't know. S&P 500, it is 0.43% to the upside, 5.19% to the downside. As far as the zones go, you can take a look at something like the VIX, right? So the VIX, right under it, we're looking at downside of 1.75%, 22.94% to the upside. So clearly the range is getting to the green on the VIX, right? Lower end. And what do you know? This is on the lower end. The S&P 500 is at the higher end. Take a look at the dollar. The dollar is also still floating around that upper end too. So price has been, for the most part, kind of grinding higher on the upper edges of the zones. And we'll see here, because the lower zones have been relatively remaining flat for the most part on some of these products, or heading down at the same time, which tells me, yeah, the downside is still growing. That is a large risk. So be careful out there, because this market is still wild. It is still volatile, and clearly the consumers are getting pinched. Hope that helps. See you later.